Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500, and today is the Boeing company, ticker BA. Over the next few minutes, I'll discuss both my valuation for this company and what I think of its business quality. This company has a market cap of $74 billion and an EV of $117 billion, so we can immediately see there's a lot of debt on this business. It operates in the aerospace and defense industry, which tends to be a relatively high-quality industry. They operate in 4 segments, including commercial airplanes, defense, space security, and global services, and Boeing Capital. As you can see in this, there are various aspects of this business that operate in various oligopolies. Commercial aircraft planes tend to be in an oligopoly with Airbus, for instance. Defense, space, and security operates in the same sort of industry as Lockheed Martin, Raytheon, and that various part of the business. Commercial airplanes business is one of the key good businesses. These tend to be very strong businesses with strong recurring revenue. Now, when we look at the return on invested capital, we can see a few things here. One of the things we see is that they have operated in fairly good profitability over the last 20 years, besides the last 3 years. So normally, if I just looked at this from 2002 to 2018, I'd say this is a very strong business. They've had growing and steadily improving returns on invested capital over time. Now, in the last 3 years, things have clearly changed. From 2019 to 2021, they've started to lose money. And so I have a lot of concerns when I look at this because declining revenue can really destroy a good business model. You know, if we look at this simply over this period, that looks really strong. 20% return on invested capital, 21%, getting up to 71%, 77% in 2018. All this is really strong numbers. Everything from 2007 to 2018 was a very strong decade. However, the last 3 years are very concerning. From a peak of 2018 revenue of $101 billion, you declined to 20. You had a 24% loss in revenue, a 24% loss in revenue, and finally some recovery in 2021. These losses in revenues are killer for the profitability of this business because your gross profit got absolutely hammered. You had a $19 billion in gross profit in 2018 that went to $4 billion, so almost a 75% drop. And then you went negative in 2020 and 2021, you finally recovered to $3 billion. A $3 billion in gross profit on a $74 billion market cap is just terrible. It's unfeasible for this business to be profitable or sustainable at this level of profitability. So we have major concerns about the future of this business. So why you show the PE ratio is negative here. Price to book ratio is negative. Price to sales, because the company's been losing money over the last 3 years, and that's devastating for analyzing the ability of this company to continue operating well in the future. So if you're liking this video so far, please hit that like button. Don't forget to subscribe and ring the bell so you can get notifications as I upload new investing videos about new businesses each and every week. So as we continue forward in this analysis, we need to take a look at the income statement. And here you can clearly see how this gross profit's gotten destroyed. Basically 90% drops in the profitability of this business from 2018 to the trailing 12 months, from $19.6 billion to $1.9 billion. In addition, you have negative operating profit for the last 3 or 4 years and negative net income over the last 3 or 4 years, and that's destroyed the business. Now, capital allocation has been somewhat nice because shares outstanding has declined from 756 million to 588 million. So you've seen that decline. They've been buying back shares. That's really good for investors. Let's go to the balance sheet. Now you see PP&E has been relatively flat. That's a good sign. You have 9.3 billion to 10.9 billion. So your assets haven't grown a ton on that area. However, you do have huge inventories in this business, doubling your inventory and doubling your current assets from 49 billion to 108 billion. So you have very large inventory assets as a big part of the asset mix for the business, and your actual PP&E isn't a huge part of the business. Now, your long-term debt has grown from 9 billion to 56 billion, 5 or 6x over the course of the last decade, which is a big reason that this company has such a massive valuation overhang. You're paying extreme amounts of interest payments on this. If we look at this, can we see interest payments here? Cash paid for financing. Now let's go back to the income statement. So net interest income, you can see they're paying $2.6 billion in interest payments over the last 12 months on gross profit of only $1.9 billion. So they owe more interest than they do in gross profit. When you have a setup like this, it would mean that you would still be losing money even if you had no employees. So the company is in serious financial straits in its ability to continue operating based upon the way that this company is set up. And so you're going to continue to see large issuance of debt simply as the company tries to survive. For me, Boeing is uninvestable based upon these numbers. Regardless of the strong history, something's clearly changed in the business that you can see here in the financials. You don't need to know anything about the business beyond these financials to see something has clearly changed and that they're no longer operating in a manner that allows for a safe, predictable investment. They're losing money, so the PE number is almost meaningless. And the valuation compared simply to gross profit numbers has this business way overvalued, completely unsustainable. I would avoid the Boeing company. It won't go on my watch list. If you enjoyed this video, hit that like button. Don't forget to subscribe and sign up for notifications by ringing the bell so you can know when I upload new investing videos each and every week. Thank you for listening, and until next time, stop paying fees, start building wealth.